Hey, what is up, guys? It's Rohan LawFX here, back with another market review. Today is March 10th, 2026, and we're going to be going over the dollar index and the stock market indices. So let's just jump right into the dollar index analysis here. So firstly, on the monthly time frame, the dollar is looking very bullish here, right? We've came down, we've swept out this sell side liquidity. The previous month in February, we had a smaller range inside bar. So after an inside bar, we can expect another bullish expansion or a larger range candle, right? We had a volatility contraction candle, and now we are seeing a volatility expansion candle. We are also seeing January's monthly high getting rated here. So January's monthly high, previous monthly high, has now been rated here in March. We can also see the previous monthly high been rated here during the February session. So if we add our PDA arrays again, if we look at the yearly time frame, right, price is still inside of that weekly buy side imbalance, sell side inefficiency. We've also rated the previous yearly low. So we've had two major confluences of a sell side liquidity raid and a rebalance. So I'm gonna mark this out as a yearly. I'm gonna mark this out as previous yearly low raid, so that we do know that price rated this low, previous yearly low raid. So you can see this is the 12-month time frame here on the dollar index. So dropping down onto the monthly time frame, we've seen the consequent encroachment of the wick acting as a resistance and price moving down into that weekly buy side imbalance, sell side inefficiency to then rebalance this gap in price action. Once this gap has now been rebalanced, the previous monthly low has also been rated. Now price is now permitted to trade higher. So now here on the weekly time frame, we're seeing the previous weekly high getting taken. So previous weekly high has now been purged and price is kind of closing in within the range of the previous weekly candle range. We're seeing the body of the candle staying inside of the range of the previous weekly candle. This could mean that this is going to be inside week. We obviously do have the CPI news drivers on Tuesday, and we also have some other high impact red folder news throughout the week. Wednesday is going to be important. We have the CPI news release. So dropping down onto the lower time frame, daily time frame, where we look for our daily bias and we get a better read of price action. We have our previous yearly low raid down here. We're then seeing the market trade down after we traded higher back into premium of this range high to this range low. We traded into premium 0.625, and then we've seen the displacement that comes in after price has traded into those key levels. So if you extend these lines right, we're seeing the 618 level being respected perfectly by the dollar index, and we're seeing the previous yearly low getting rated. Excuse me. So once the previous yearly low was rated, we see this massive down close candle. We're then seeing reaccumulation back inside of the range that was created from this swing high to this swing low. This is a new dealing range, right? From the initial dealing range high to the dealing range low, if we measure out the range, we can see we are in premium of the range, and we can see 0.79 Fibonacci level acting as a potential resistance level after we have also rated the buy side liquidity resting above this swing high. So now that we have a drawn liquidity being taken, right, and now we're closing inside of the range, my thesis for dollar is I want to see price come down and rebalance this daily inefficiency. If we are able to rebalance this daily inefficiency, I'm going to see price trade lower to then go back higher to take out the range high, and that would complete this market maker buy model on the buy side of the curve. On the left side of the curve, we have our sell side models. On the right side, we have our buy side model. So potentially throughout the rest of the week, I'm expecting CPI to drop the dollar index into this daily BISI. Once that daily BISI has been rebalanced, we can then see price potentially move higher because we are still inside of that yearly inefficiency. So if we grade this yearly inefficiency in quadrants, right, because this is a larger inefficiency and we're seeing price rebalance here on the daily, we can now grade this level and then see the gradients within that daily, that yearly buy side imbalance, sell side inefficiency. Just making sure I have the annotations plotted correctly because I like my annotations to be as exact as possible. We can see here on the dollar index, we've displaced through equilibrium or the consequent encroachment of that yearly BISI. And we're seeing price now kind of consolidate in this range. We've taken the buy side above the high and we've taken the sell side below the swing low down here. So now buy stops have been rated and sell stops have been rated, right? I'm still anticipating a bullish dollar due to the war news and due to the economic calendar. If Trump is able to stop the war in Iran and the crude oil prices continue to go lower, we could see a more bullish dollar. I am anticipating a more bullish dollar shorter term. Longer term, I'm still bearish on dollar, but longer term, I do want to see some of these buy side liquidity pools get rated, like this swing high up here as well, potentially this buy side as well. We've rebalanced this inefficiency we've traded through. This was indicative of bullish price action when price was unable to respect this SIBI. Now it is turned into an inversion. We also have this smaller inefficiency being respected by the wicks of the candles. Look at the bodies not being able to close below that little inefficiency that we have in here. So from this swing low to this swing high, this is a dealing range, right? We have sell side liquidity rated and we had buy side liquidity rated. We see the market trade back into discount of the range closer to the 618 level. We're then seeing the displacement. So if we mark a standard deviation from this range low to this range high, we can see price coming up to the 0.5 deviation, and that is where we're seeing the consolidation. So once price has consolidated enough around here, we could potentially get a reaccumulation inside of this daily buy side imbalance, and then I want to see the -1 deviation get hit here while also rating the buy side liquidity. And look how the -1 deviation is lined up perfectly with the buy side liquidity resting above this swing high, right? So that is going to be my analysis for dollar. As I said, I'm expecting a rebalance of this daily inefficiency, and then I'm expecting a bullish move towards the buy stop order liquidity resting above. Now if you look on the H4 time frame, here is that buy side liquidity raid that we did have here. The market then traded lower into another fair value gap. This fair value gap has now been rebalanced. We then see the market trade higher, consolidate. Excuse me. We then see this short-term low get purged here. Then at 5 p.m., we see the massive expansion for dollar, taking out this swing high with a shallow sweep, not a really deeper purge, just a shallow raid above this single high, right? So after liquidity has been raided, we can either expect this high to act as a key level or a reversal point. This level is now acting as a reversal point, and we see this larger imbalance not being respected. See price trade into the low. We then see price raid out a level of sell side liquidity, which is resting below this low while also staying inside of this H4 inefficiency. I'm anticipating now this H4 inefficiency to act as a level of resistance to then see price drop lower into the daily inefficiency. If price is unable to drop lower into the daily inefficiency and then we just continue higher, I'm going to label this inefficiency as a breakaway gap. this is going to be indicating to me that price is in a hurry or in a fast moving market to then trade towards the buy side. If we fail at this level because we're in a premium relative to the dealing range, right, we can see we're in a premium. We're in a pretty deep premium, I would say, relative to the range. Equilibrium is right here, right? And we're rejecting and we're respecting the 0.79 level. No bodies were able to close above this level. So if we were to trade lower on CPI, I'm going to wait and see how price is going to react to this daily inefficiency. Once we either rebalance the inefficiency or start trading higher again, then I will have a new thesis. But I'm liking these relative equal highs. There's going to be some buy side liquidity above these highs, and then potentially the range high here, like completing the sequence of the market maker buy model from sell side to buy side. Next thing that I want to talk about is going to be the NASDAQ. So NASDAQ overall, we're still stuck in this larger range. Today was a little bit of continuation of the previous day, Monday, bullish thesis that we had, right, due to the Trump news that he was going to negotiate with Iran, and also Trump talking to Putin about ending the war, right? That caused the market to rally aggressively during the 3 p.m. candle yesterday. So looking at NASDAQ, we're just stuck in this range, and it's just very nasty and disgusting. While looking at the monthly time frame, the previous monthly candle low has been raided. This larger pool of sell side has been raided, and now the market is permitted to reverse. The market is now reversing back into the range of the previous monthly candle. If we drop down onto the weekly, I do not see very many PD arrays here, but if we drop down onto the weekly time frame, we see on the left side of the chart that we have a weekly buy side imbalance, sell side inefficiency, a smaller one, but it is still valid, and we can see all bodies respecting this inefficiency from the left side of the chart. Look at the top, look at the respect of this level. Not one candle body was able to close below this level. This is why this is a important key level for me. This is a higher time frame key level that is very important to me for the NASDAQ. We see the market raid the sell side liquidity here on Monday. We drop down onto the daily time frame. This is our weekly inefficiency. We see the market purge that liquidity here on Monday. Larger range candle than previous ranges. Levels of sell side being 3 levels of sell side being raided on Monday. We then see Tuesday acting as continuation of the bullish trend that was confirmed on Monday. So for the rest of the week, I am anticipating bullishness, and I'm anticipating this buy side liquidity to get purged. Once that buy side liquidity is purged, I could potentially look for the range high. That's going to be a little bit farther away in terms of targeting, but it is still a valid draw on liquidity that could be reached within the next month or two. So looking at Tuesday's price action here on the NASDAQ, we can see this high getting purged, right? So Friday, March 6th high gets purged on Tuesday. If we drop down onto the H4, we can see structure a little bit better. We see the candle purged, then we see the manipulation lower at 6 a.m. Then we see the 2 a.m. candle high getting purged here at 10 a.m. We see price trade above our new week opening gap, and price did not rebalance this bullish inefficiency. If we look at our other indices, we're not seeing price rebalance. We're only seeing the rebalance with the Dow Jones. So the Dow Jones was able to rebalance this inefficiency, while the ES and the NQ left this inefficiency open. This was a clue to me, indicating that there is SMT inside of this inefficiency, and indicating to me that price is going to be bullish today. So dropping down from the H4 into the H1, this is a range. We're trading in a range, right? So we rated the buy side liquidity initially here at 4 a.m. during the London session. If we look at our structure, we have a swing low, swing high getting taken, price retracing back into discount of the range, also 0.79 level lining up perfectly. So we see the candle body right here, leaving these relative equal lows down here. Price left these relative equal lows after we traded into discount of this range low to range high. So on the H1 time frame, I want to break down the market here. So we see this H1 fair value gap here acting as a support level. We see price trade into that once, trade into that twice, and then see the reaction higher. We have this H1 inefficiency that I was using as an inversion level to then look to take a trade as well. We're seeing price move higher here during the afternoon session. Let's add our day dividers. So initially during the New York Open, we see the market trade higher. We expand during the London session, and we raid the previous daily high. So previous daily high has now been raided during the London session, and we also raid Friday's high here during the London session. Once we purge those liquidity pools, the market then trades aggressively lower, and we get a turtle soup raid above a 6 a.m. high here at 7. That causes the market to reverse lower, trading into the H1 fair value gap. Once that H1 fair value gap has now been rebalanced, we engineer more liquidity. We see the market trade higher, engineering this high to then get taken at a later time. Dropping down to the M15 now, we see the higher time frame arrays being respected. We see the higher time frame arrays that I was using, and we see the liquidity pools that I was targeting. So initially here at 8:30, we see a bullish move. 9:30, we trade higher. We rebalance this 15-minute inefficiency, which we eventually trade above, making this an inversion fair value gap. So the market then trades lower here on 9:30 opens, 9:45, 10 a.m. Then 10:15 trades lower, takes out the 10 a.m. candle low. If we look at the ES, we see ES made a lower low. YM also made a lower low, while the NQ failed to make a lower low. NQ, this price level is 24,892.25. This price level is 24,892. So about a 0.25 or a 25-cent differential from price taking out this low. That is algorithmic to say the least. But we then measure the range high to range low. So we then see the market trade lower. We can also get a standard deviation target just using that projection. So using the projection, we had a 0.5 deviation higher, which was never hit. So now dropping down onto the M1 with our higher time frame levels marked. We initially see the market consolidate here. We initially break away from the fair value gap that was created here at 9:30. This fair value gap was not respected at all. So we see the price trade into that level, consolidate, drop down, trade higher, run the buy stops resting above this high, trade into a fair value gap that was not rebalanced. We rebalance that inefficiency. We then see the market trade lower aggressively, trade back higher to rebalance again. Then we get the expansion move lower. We trade through this fair value gap, which was initially respected. We then trade to that fair value gap again, and we see the displacement lower. This blue shaded box is our H1 inefficiency. This is our 8:30 opening price. So we then see the market trade down lower. We get a sell side liquidity raid, below this low, right? So this is indicating that this up close candle is now a bullish breaker. So when price trades above this bullish breaker, and we also trade above the H1 inefficiency, this is when you could be looking for a long setup. We trade through this H1, this M1 bearish inefficiency, making this an inversion gap. So we have an SMT divergence here with ES and NQ. ES making that lower low, NQ failing to do so. We had a shorter term sell side raid, making this up close candle a bullish breaker. We see price disrespect the breaker, disrespect this inefficiency, indicating to me that prices were now bullish. We left this large pool of buy side liquidity here at 4 a.m. We left buy side liquidity above the 9:30 a.m. candle, and we left this pool of buy side above here at 7 a.m. So then we could have looked to enter a trade position as soon as this candle, this fair value gap, gets inversed. We see the inverse occur here. My invalidation is going to be a candle body closure below the breaker. That is where my stop. The first TP is going to be this swing high as for a 2.83R trade. So that was the trade that we took today. It netted us about a 2.83R. We see all the bullish inefficiencies acting as support. We're seeing down close candles acting as support as well. This is indicative of bullish institutional order flow. Look at these down close candles acting as support for price, pushing price higher, leading us towards the end of the day. We see the drop, and then we see price potentially continue consolidating. But that was the breakdown on the NASDAQ today. It was a pretty easy day. I wouldn't consider it easy, but it was a nice one-sided move that we had after 10 a.m. So once the 10 a.m. power of 3 pretty much occurred, we see 10 a.m. open, right? We create the wick initially. Price drops down. We create the wick of that H4 candle. Price then displaces, the candle turns green here. We displace through that inversion. We then see the market trade higher, rebalance of inefficiency, price trading through the inversions from the M15 and H1. Buy side liquidity targets getting hit and purged. Down close candle still acting as support, and eventually our final target gets hit. Right, using the first presented fair value gap, the first presented fair value gap would have been this gap right here. This would be the 930 fair value gap. This would have been 933. So this would actually be our first presented gap, and we completely respect that level here, and we see the displacement that occurred. But we then see the market inverse that level and find support off the bullish inefficiency plus this inversion level, and then we're seeing the market trade higher. So based on this H1 sequence, I'm suspecting that the low of the week was put in here on Monday. I'm expecting Monday to be a protected low. I do not want to see price trade below Monday's low. If we do trade below Monday's low, then we could see the market potentially come down and raid sell side here. Depends on what CPI is going to do. My prediction for CPI is we raid the low resistance liquidity above this high here, and these relative equal highs above here, or these failure swings up. I do believe these failure swings are going to be the next draw, right? As we can see, I believe the next draw on liquidity is going to be this swing high for CPI. In terms of CPI news release for tomorrow, get rid of my annotations here. So I'm anticipating this buy side liquidity to be purged. If that buy side liquidity gets purged, I'm looking at potentially price trading into this fair value gap. If we trade into this fair value gap, we would be also trading into this pool of sell side, right? And we also have this nice little trend line liquidity that is building up here. So we could see price potentially come down, manipulate, take out that sell side liquidity, and then we see the market trade higher. If the market does not want to manipulate and we just continue to distribute higher, which I do believe is going to happen, I do believe price is going to continue to distribute higher, then price is going to continue to distribute higher, and we're going to be looking for longs the rest of the week. I'm going to have a bullish bias, and I'm going to keep my bullish bias here on NASDAQ. If we look at ES as well, ES failed to take out this swing low. So the low is 6,583. The low of this candle is 6,584.50. So pretty much $1.50 away from taking out this swing low. Right? So you're telling me every single seller in the world stopped it right before price took out this low? If that is not algorithmic, I do not know what is, right? That has to be algorithmic. You're telling me every single seller in the market stopped price before it purged this low, while NQ already did. ES looks a little bit less choppy than the NASDAQ right now, but we did fail to take out Friday's high, while NQ did. I'm still bullish on all stock indices currently. Shorter term, I'm still bullish. Longer term, we're still going to be waiting and seeing. But longer term, I'm bearish on stock indices. Shorter term, I'm bullish because it's looking like every single news that event that gets released, right? We've already taken out major pools of sell side. I wouldn't believe that sell side liquidity pools are still going to be targeted here. I'm anticipating buy side liquidity pools to now be targeted, right? There's going to be a lot of resting buy stop orders or buy limit orders above these highs up here. So we could see the market completely run all these highs and we enter another buy program. If that is the case, then we're going to see these failure swings all being purged. If that is not the case, then we're going to see price continue trading lower, and we left these relative equal highs, relative equal lows on the ES and the YM for a reason, right? And why was that reason? The reason price manipulates or engineers liquidity is so that it can go and take that liquidity at a later date. Just because imagine all these sell stop orders that are resting below this low in terms of institutional money. There's huge pools of liquidity resting below these swing lows. There's huge pools of liquidity resting below these swing lows, right? Huge pools of liquidity on ES and the YM that have been left. So we could potentially see the S&P 500 and the Dow Jones come down and take those liquidity pools. Those liquidity pools are obviously going to be hit. We just do not know when. And shorter term, right, we're in a discount, right? So from a discount, we trade back into a premium. If we measure the range on the Dow, right, equilibrium of the range lines up around the 48,500 level. If we look at the ES, right, we're a little bit higher in premium, right? We actually reached the equilibrium level, so we could see consolidation here on ES. The NASDAQ, if we look at the range high to range low of this swing, right, we're still yet to trade into equilibrium. We've traded into equilibrium and we've rejected. So I want to see if price can trade back into that premium. So that is going to be the market review for March 10th, 2026. Thank you guys so much for watching, and I'll see you guys tomorrow for our daily review on CPI. It's going to be nice. Make sure you guys manage your risk. Think in terms of probabilities, because that is what trading is. It is managing risk and is thinking in terms of probabilities, right? Because if you do not manage your risk, then you won't have any money left to trade, right? And that's what all you guys want to do is obviously trade. So make sure you guys manage your risk accordingly to the market conditions. It is currently high volatility, and we're still stuck in these ranges on the stock market indices. So once these ranges are broken out of, we can then see some nice trends in the market. Thank you guys so much for watching. I'll see you guys tomorrow.